Hi class, how are you? Here we are again for another video class. So let me share my screen with you. Today we're going to be talking about money management. This is a very important thing, so pay attention to it. Okay, so here we are, money management. So people must manage their money to have enough for their needs and their wants. So we all have to be very careful with the money, the way that we spend it, okay? Many people save and invest money, and we're going to be talking about investments in a little while. Money is anything that is generally accepted as payment for goods and services, and that we all know. We know that in the past, money used to be, for example, seeds or beads or any other type of object that was used to exchange for goods and services. But for a very long time, we have been using money. Money is a scarce resource. There's not a lot of money. So people have to manage it to have enough to meet their needs and their wants. Because normally people's needs, wants, and incomes can change, it is important to plan ahead. So it's always very important to know what you are going to do with your money, depending on how much money you are making, how much money you are spending, and you have to plan ahead what are you going to be doing with your money. So we're going to talk about budgeting, saving, and lending. So a key tool for money management is budget. And a budget is how you manage your money. You make a plan of how much you are going to spend on your needs and how much you can save. So for example, let's say you have 100 pesos, okay? So you're going to make your budget from that 100 pesos and you're going to decide, like for example, you're going to spend 50 pesos in your lunch, 10 pesos in a beverage, and you have 40 pesos left that maybe you can save. That is making a budget. So a budget is a plan that shows income and expenses over a period of time. So by using a budget, we are going to see how much money we are making and how much money we are spending, okay? So a budget's income should be equal or greater than the expenses. We need to have at least the minimum amount to cover our expenses, but the ideal thing is that we have a little bit more money so that our budget can cover our expenses and we can have a little bit of money left. So a budget should also include money reserved for saving. Okay, so this is how you make your budget. Like I was explaining, if you have a certain amount of money, you are going to decide how much money you're going to spend, in what are you going to spend it, and if you have any money left, so you are able to save something. Saving is the act of setting aside money for future use, and this we all know, that saving is separating some money for the future. So many people, the way that they save their money, it's by using a bank. So a bank is a business that keeps money, makes loans, and offers other financial services. So there are two ways that we can save money. We can save it in our house, in a piggy bank, or in an envelope, or we can open a savings account in the bank. Many people who save money in banks, they do so by using a checking or savings account. A checking account is where they're going to give you a little booklet with checks that you can use like money, or you can have just a savings account that you are not going to be touching. It's just for saving your money. Now, we have what interest. So interest can mean two different things, and pay attention to this. The money that the bank gives you for having your money in the bank, that is the interest that the bank is paying you for having your money in the bank. And the other meaning of interest is the money that you have to pay when you get a loan from the bank. So interest is an incentive for people to save money. So let's look at this chart on the left-hand side. This is your savings account. So the columns in yellow, what it's painted in yellow, this is your money. So the more money you have in the bank, in your savings account, the more interest that the bank is going to be paying you. This would be what it's shaded in red. So the more money that you have, the more money that the bank is going to be giving you, or an interest on your money. So the bank is giving you an interest on your money, okay, from the money that you have in the bank. On the other hand, if you look at the picture on the right-hand side, we have the interest that you have to pay when you get a loan. So for example, let's say that you borrow $100 from the bank, you're going to have an interest rate of 6% over the period of 1 year. So that means that when you are going to pay back the bank for the $100 that you borrowed, you have to pay them $6 more. So in total, it would be $106. So this is the interest that you have to pay to the bank when you borrow money from them. Banks use the deposits to make loans to people and businesses around the world. So the bank is a business. When we have a savings account, the bank is going to be using our money to make loans to people and businesses, okay? That's why the bank is paying us an interest in our savings account for managing our money. But this money that we deposit in the bank, it's allowing the bank to make a business by lending money to other people or businesses and charging them an interest. That's how the banks work. So these loans can help people buy houses or make other large purchases, like maybe buying a car. So when you need to spend a lot of money that you don't have for something that is very expensive, you get a loan from the bank and you're going to pay an interest over a period of time over that loan. So these loans help businesses get started and grow. As a result, banks are a big part of the economic growth. So here we can see the picture on the left-hand side, how you can borrow money to buy a house, and the bank is going to make an arrangement with you for payments every month over the course of a year or several years with an interest. So for example, let's say that you borrowed 1 million pesos to buy a house, and you're going to pay it over the course of 2 years. So every month you're going to be paying a part of your loan with an interest added on it, okay? And the same thing when you borrow money to open a business. You are going to get the money from the bank and you're going to be paying it back depending on the arrangement that you make with the bank, which can be every month or every 6 months or every year. But the bank is going to charge you an interest for that money that you borrow. This way the bank is making money and it's giving you the facility of borrowing the money so that you can either buy something or start a new business. Loans are a form of credit. So when you get a loan, it's the same thing as if you were getting a credit. So a credit is an arrangement in which a buyer can borrow money to purchase something and pay for it over time, such as by using a credit card. So the use of the credit card It's much the same thing as a loan. When you go to a store and you pay with a credit card, the credit card later on when you pay it, if you pay it on time, you don't have to pay any interest. But if you cannot pay your credit card on time and you are paying it over the course of several months, the credit card company is going to charge you an interest. It's going to charge you a little bit extra money than what you spend, okay? So banks and other lending organizations charge borrowers interests on loans. So when you use a credit card or when you borrow money, you're always going to be paying an interest. You're going to be paying extra money, okay? So as a result of this, it costs more for a borrower to purchase a good using a credit than to pay cash for the good. When you pay cash, you don't have to pay interest because you are already paying for the service or for the goods, the total amount. But when you're using a credit, you're going to end up paying an interest, so you're going to end up paying a little bit extra money. Let's talk about investing. So investing is the act of using money in hope of making a future profit. Some people invest in stocks, bonds, or mutual funds. Let's see what these things are. So a stock is a share of ownership in a company. So you have a company and you can sell shares of your company to other people and they become investors. When they are buying stocks in your company, they are becoming associates in your company or investors in the company. So if you buy stock in a company, if the company is making a lot of profit, you are also going to make a profit because by being a stockholder, you become a part owner of the company, okay? So that is a stock, when you buy a share of ownership in a company. A bond, on the other hand, it's a certificate issued by a company promising to pay back borrowed money with interest. So a bond is when a company borrows money from you. So the company in time is going to pay you an interest on that money that they borrowed from you. So let's say there is a company that makes tennis shoes and they ask me for $100,000. So they are giving me a bond in which later on, when they make a profit on the sale of the tennis shoes, they are going to be paying me money because I invested in their company and I got a bond with them, okay? And a mutual fund, it's a company that invests members' money in stocks, bonds, and other investments. So a mutual fund, it's a company that what it's doing, it's helping you with your money. So it decides whether it's going to invest your money in stocks, in bonds, or in other investments with the purpose that you make money in the future over your own money, okay? So investments offer different levels of risk and return. The return is the amount of money an investor might be earning. So in general, the safest investments offer the lowest rates of return or profit. So if the investment is very safe, it's not a high risk investment, normally the interest or the money that you're going to get from it, it's not going to be very much. It's going to be a very low profit, but it's a safe investment. Your money is safe, okay? So, for example, a savings account. If you have a savings account in the bank, that is one of the safest investments because your money is going to be staying in the bank and the bank is going to be paying you some money, for some interest by having your money in the bank, but the interest is not going to be very high. So you're not going to be making a lot of money. You're going to be making a little bit of money, but not a lot. So it's a safe investment. Stocks are riskier, but you can earn a great deal of money if the investor, if the investment increases in value. So let's say that you bought stocks in a company that makes cars. So if the company starts selling a lot of cars and they start making a lot of money and you have stocks in that company, you are also going to be making a lot of money in interest from the stocks that you bought in this company. So remember that stocks are a share of ownership in the company. You become like a part owner of the company when you have stocks, okay? So the better that the company is doing, the more money that they are making, the more money you are going to be making in your investment, in your return, okay? Now, it can happen that the stocks can decline in value and become worth less than the stockholder paid for them. In other words, a company, maybe a manufacturing company of tires, let's say tires, okay? So if the tires start losing price and the company it's not making a lot of profit, you are going to lose money because you invested in this company and this company it's not making money, so you are not going to be making any money, and you also run the risk of losing the money that you invested, your stocks, okay? Now, bonds are less risky than stocks, but the same thing, because they are less risky, they offer a lower rate of return or profit. So you're going to be making less money of interest in bonds, but they are safer than stocks, okay? The way that banks function, it's by keeping money from savings or checking accounts and using this money to make loans and offer other financial services. So the banks, they pay interests on savings and they charge interests on loans. So you can see it here on the picture on the left. You make a deposit in the bank keeps your money, and it gives you an interest. You're making money off of it. So the bank is going to pay you for having your money in the bank. On the other hand, if you look at the picture on the right, okay, if you ask for a loan from the bank is going to give you money. You're borrowing money from the bank. So the bank is going to charge you an interest. You're going to have to pay the bank. Instead of the bank paying you, you're going to have to pay the bank an interest on the money that the bank is lending you. Okay? So let's review the key terms and take notes in your notebooks from this lesson about what is a budget, what is a saving, an interest, a credit, what is investing, what is a stock, and what is a bond. So make sure that you take notes of those key terms in your notebook and watch the video again, because this lesson, it's very interesting and it's a little not complicated, but you need to pay attention to it, okay? And I will see you next time, guys. Have a good day. Bye-bye.